Most traders think RSI is a signal tool. That's the first mistake. They see RSI above 70, they think the market must fall. They see RSI below 30, they think the market must rise. But if it were really that simple, wouldn't everyone be consistently profitable? Look closely at strong trends. How often does RSI stay overbought for much longer than traders expect? How often does it remain oversold while price keeps moving lower? The indicator isn't failing. The trader is asking the wrong question. RSI is not telling you where price must go next. It's showing you the strength behind the current move. Think about what RSI actually measures. It compares recent buying pressure to recent selling pressure. When RSI climbs, buyers are dominating. When RSI falls, sellers are in control. Simple. Yet many traders use this information to fight the trend instead of understanding it. And what happens when you constantly trade against strength? You end up entering too early, taking unnecessary losses, and questioning a perfectly useful tool. So let's simplify it. When RSI reaches high levels during an uptrend, don't immediately ask, when will this reverse? Ask, why is buying pressure so strong? That question changes everything. Strong RSI readings often confirm momentum. Weak RSI readings often confirm weakness. The implication is important. Markets usually continue moving in the direction of strength longer than most people expect. Does that mean RSI can't help identify reversals? It can, but not in the way most traders use it. One of the most valuable observations is divergence. Price makes a new high, but RSI fails to do the same. Or price makes a new low while RSI shows improving strength. What is that telling you? It suggests that momentum is no longer supporting price with the same conviction. The crowd is still pushing, but the force behind the push is weakening, cause and effect. First momentum fades, then price becomes vulnerable, but even divergence is not an automatic trade signal. This is where patience separates professionals from amateurs. Many traders see divergence and enter immediately. Experienced traders wait for price itself to confirm the change. Why? Because momentum can weaken long before a trend actually ends. The market doesn't reward being first. It rewards being right. Now consider another practical use of RSI. Watch how it behaves during pullbacks. In a healthy uptrend, RSI often pulls back without reaching deeply oversold conditions. Buyers step in early. That's information. In a strong downtrend, RSI may struggle to reach overbought levels during rallies. Sellers remain dominant. That's information too. Can you see the pattern? The indicator becomes more useful when you stop treating it as a trigger and start treating it as evidence. Evidence of strength, evidence of weakness, evidence of changing behavior. And once you begin reading RSI this way, you stop asking whether 70 or 30 is the magic number. Instead, you start asking a much more valuable question. What is the market revealing about the balance between buyers and sellers right now? Most traders look at RSI and immediately start making predictions. RSI goes above 70 and they expect a reversal. RSI drops below 30 and they expect a bounce. The indicator becomes a forecasting tool in their mind. But that approach creates a problem from the very beginning. What if RSI was never designed to predict the future? Think about it for a moment. If a market is moving higher day after day, what should RSI do? It should rise. If buyers continue to dominate, RSI should remain elevated. That's not a warning sign by itself. That's evidence of strength. The mistake happens when traders confuse strength with exhaustion. Have you ever watched a stock continue climbing while RSI stayed overbought for weeks? Many traders have. They sell because they believe the indicator is telling them the move is finished. Meanwhile, the trend keeps advancing. The indicator wasn't wrong. The interpretation was. RSI measures pressure. More specifically, it measures the balance between recent buying pressure and recent selling pressure. When buyers are consistently winning that battle, RSI rises. When sellers are controlling the action, RSI falls. The indicator is reporting what is happening beneath the surface of price. That distinction changes everything. Instead of asking, what will happen next? Start asking, what is happening right now? A rising RSI tells you buyers are becoming more aggressive. A falling RSI tells you sellers are gaining control. Neither observation guarantees the next move. It simply reveals the current condition of the market. And current conditions matter, because markets move through pressure, before they move through price. When institutional money enters a market, buying pressure often increases before most traders recognize the significance. RSI can reflect that shift. When large participants begin distributing positions, momentum may weaken before a major decline becomes obvious. RSI can reflect that as well. The indicator is not predicting, it is revealing. This is why context matters so much. An RSI reading of 75 means one thing in a powerful uptrend and something completely different in a weak, range-bound market. The number itself is not the message. The environment surrounding the number gives it meaning. Many traders search for certainty in indicators. They want a specific level to tell them exactly when to buy or sell. Markets rarely work that way. The better approach is to treat RSI like a piece of evidence. Imagine you're trying to understand who controls a market. Are buyers stepping in aggressively? Are sellers dominating every rally? Is momentum expanding or fading? RSI helps answer those questions. When RSI repeatedly reaches high levels during an uptrend, it often suggests buyers remain committed. When RSI struggles to rise during rallies, it can signal weakening demand. When RSI begins making lower highs while price continues climbing, it may indicate that buying pressure is no longer increasing at the same pace. Notice what's happening here. You're no longer using RSI as a crystal ball. You're using it as a window into market behavior. And market behavior is what ultimately drives price. The strongest traders focus less on prediction and more on observation. They understand that no indicator can guarantee the future. What an indicator can do is provide insight into the forces currently shaping the market. RSI becomes far more useful when viewed through that lens, not as a signal generator, not as a shortcut, but as a tool that measures pressure. One of the most expensive habits in trading is believing that overbought means sell. It sounds logical at first. If RSI rises above 70, the market must be too expensive. If something has already moved up significantly, surely it can't continue much further. That's how many traders think. But markets don't move according to what feels reasonable. Have you ever noticed how the strongest trends often become even stronger after RSI enters overbought territory? That's because overbought does not mean a market has gone too far. It means buying pressure is unusually strong. Those are two very different ideas. Think about what RSI is actually measuring. It compares recent gains to recent losses. When buyers consistently dominate, RSI climbs. When that dominance becomes extreme, RSI reaches overbought levels. The indicator is not saying sell now. It's saying buyers are currently in control. Many traders see the same information and draw the opposite conclusion. Why does this happen? Because people naturally look for reversals. They want to buy low and sell high. They want to catch turning points. There is something emotionally satisfying about being early. The problem is that strong markets rarely reward traders simply for being early. A stock can remain overbought for days, sometimes weeks, occasionally even longer. During that period, traders who keep selling because RSI is above 70 find themselves fighting a trend that has no interest in reversing. The market doesn't care that an indicator has reached a certain level. What matters is whether buyers are still willing to pay higher prices. As long as demand remains strong, overbought conditions can persist. This is where understanding cause and effect becomes important. Most traders see high RSI and assume a reversal must come next. Experienced traders recognize that high RSI is usually the result of aggressive buying, and aggressive buying often attracts additional buyers. Momentum creates visibility. Visibility attracts attention. Attention attracts participation. The very condition that many traders interpret as weakness can actually be evidence of strength. Does that mean overbought readings should be ignored? Not at all. They simply need to be interpreted correctly. An overbought reading tells you the market is moving with unusual strength. That information is valuable. It helps you understand the character of the trend. Instead of immediately looking for a short trade, ask a different question. Why is the market so strong? Are institutions accumulating positions? Is there a powerful trend underway? Is momentum expanding rather than contracting? These questions lead to better decisions than automatically assuming a reversal. In fact, some of the best trend-following opportunities occur when RSI moves into overbought territory and then remains elevated. Why? Because sustained strength often reveals sustained demand. Weak trends struggle to maintain high RSI readings. Strong trends don't. Another observation worth paying attention to is how RSI behaves after reaching overbought levels. Does it collapse quickly? Or does it pull back modestly before recovering? When RSI remains resilient, it often suggests buyers are still active. Sellers may attempt to push prices lower, but they fail to gain meaningful control. That behavior tells a story, and trading is often about learning how to read that story. The market constantly leaves clues through momentum. RSI is one of the tools that helps reveal those clues. The mistake is treating overbought as a command to sell. The better approach is to see it as evidence that buying pressure has reached an exceptional level. Most traders see an extreme RSI reading and think they already know what it means. RSI above 70, the market is overbought. RSI below 30, the market is oversold. Simple, quick, easy to remember. But the market is rarely that simple. The real value of RSI extremes is not the number itself. The real value is the story hidden behind that number. Think about it. An RSI reading doesn't appear by accident. It is the result of traders making decisions, buyers competing with sellers, fear pushing some participants out, and confidence pulling others in. Every extreme reading represents behavior, and behavior is what moves markets. When RSI reaches unusually high levels, most traders focus on the possibility of a reversal. But before worrying about a reversal, ask yourself a different question. What had to happen for RSI to reach that level in the first place? The answer is aggressive buying, not ordinary buying, not hesitant buying, consistent and forceful demand. That demand may come from institutions building positions. It may come from positive news attracting attention. It may come from momentum traders joining a trend. Whatever the reason, the market is revealing something important. Buyers are willing to pay increasingly higher prices. That information matters, because markets do not rise simply because prices move higher. They rise because participants are willing to keep buying despite higher prices. An extreme RSI reading is often evidence of that willingness. The same principle applies in reverse. When RSI falls to unusually low levels, many traders immediately start looking for buying opportunities. They assume the market has become too cheap. But what had to happen for RSI to become deeply oversold? Strong selling pressure. Sellers were willing to accept lower and lower prices. Fear increased. Confidence weakened. Momentum shifted. Again, the extreme reading is not the story. The pressure behind the reading is the story. This is why two identical RSI readings can mean very different things. Imagine two stocks with an RSI of 75. One stock has just broken into a powerful new trend with increasing volume and broad participation. The other has reached 75 after a short rally inside a larger downtrend. The numbers are identical. The message is not. The hidden story behind each reading is completely different. That's why successful traders rarely focus on RSI levels in isolation. They study the environment surrounding those levels. What is price doing? Is momentum expanding or weakening? Is the trend healthy or struggling? Are buyers becoming more aggressive or less aggressive? The answers provide context, and context transforms information into insight. Have you ever noticed how some markets become overbought repeatedly during strong trends? Many traders view this as a warning. Professionals often view it as confirmation. Repeated extreme readings can reveal persistent demand. They suggest that buyers continue returning even after temporary pullbacks. The market keeps generating enough pressure to push momentum back into extreme territory. That behavior tells you something about conviction. Likewise, a market that repeatedly becomes oversold may be revealing persistent weakness rather than hidden opportunity. The crowd often wants to buy weakness and sell strength. The market often rewards understanding strength and weakness before acting on them. RSI extremes become far more useful when you stop treating them as signals and start treating them as evidence. Evidence of urgency. Evidence of conviction. Evidence of fear or confidence. Many traders watch price. Professional traders watch behavior. That difference may sound small, but it changes the way you see the market. Price tells you what happened. Momentum helps explain why it happened. And when you understand why a move is occurring, your decisions become clearer. This is where RSI becomes valuable. Most traders use it as a signal generator. They wait for a line to cross a level, then rush into a trade. But momentum is not something that can be reduced to a single number. Momentum is the force behind price movement. Think about a car traveling down a highway. Two cars may be moving at the same speed, but one is accelerating while the other is losing power. From a distance they appear similar. Underneath, they are very different. Markets work the same way. Price can continue moving higher while momentum weakens. Price can temporarily pull back while momentum remains strong. RSI helps reveal those differences. The question is not whether price is rising or falling. The question is how much strength is supporting that movement. Have you ever noticed that some trends seem effortless? Price advances steadily. Pullbacks are shallow. Buyers return quickly after every decline. RSI often reflects this behavior by staying in higher ranges. That's momentum. The market is telling you that demand remains strong. Now compare that with a market that struggles to make progress. Price rises for a few days, then gives everything back. Every rally feels unstable. RSI repeatedly fails to reach strong levels. That is also momentum. Not strong momentum, but weak momentum. The indicator is showing you that buyers are not controlling the market with the same confidence. This is why professional traders focus less on individual RSI readings and more on RSI behavior. Behavior reveals character. For example, imagine a stock pulls back during an uptrend. Many traders become nervous because price is falling. They assume the trend is ending. But what if RSI only retreats modestly before stabilizing? What if momentum remains stronger than expected? That observation tells you something important. Buyers may still be in control despite the temporary decline. The market's internal condition has not changed as much as the price action alone might suggest. Now consider the opposite situation. Price continues climbing, making fresh highs. Everything appears healthy on the surface, but RSI begins forming lower highs. Momentum is weakening even though price is advancing. Why does that matter? Because trends require energy. When momentum fades, the force driving the trend begins to diminish. The market may continue moving higher for a period of time, but the underlying strength is no longer increasing. The first sign of change often appears in momentum before it appears in price. This doesn't mean every momentum slowdown leads to a reversal. Far from it. The goal is not prediction. The goal is observation. Professional traders understand that markets leave clues before making significant moves. Momentum is one of those clues. It reveals participation. It reveals conviction. It reveals whether buyers or sellers are becoming more aggressive. And once you start viewing RSI through that lens, you stop asking simple questions like, is RSI above 70 or is RSI below 30? Instead, you begin asking more useful questions. Is momentum strengthening or weakening? Is buying pressure increasing or decreasing? Is the current trend gaining support or losing support? Most traders use RSI to look for reversals. They spend their time searching for signs that a trend is about to end. They watch for overbought conditions, oversold conditions, and every possible signal that suggests a turning point is near. But what if RSI is often more valuable when it confirms a trend instead of fighting it? That idea sounds simple, yet many traders overlook it. Think about strong trends for a moment. They rarely move in a straight line, but they do share certain characteristics. Buyers remain active. Sellers struggle to gain control. Pullbacks are temporary. Momentum repeatedly returns. RSI can help reveal this behavior. When a market is trending higher and RSI consistently reaches strong levels, it is telling you something important. Buying pressure is not disappearing. Many traders interpret a high RSI reading as a warning sign. They assume strength has gone too far. But a trend cannot continue without strength. The very condition they fear may actually be confirming that the trend remains healthy. Have you ever noticed how the strongest stocks often spend long periods with RSI moving in higher ranges? That's not an accident. Strong trends tend to generate strong momentum. Strong momentum produces elevated RSI readings. The indicator is reflecting the reality of the market. Buyers are willing to keep paying higher prices. As long as that behavior continues, the trend has support. This is why context matters so much. An RSI reading of 70 means very little by itself. What matters is how RSI behaves relative to the trend. If price is making higher highs and RSI repeatedly recovers after pullbacks, that behavior suggests buyers remain engaged. Momentum weakens temporarily, then strengthens again. The trend continues receiving fresh participation. That's confirmation. The indicator is supporting the message being delivered by price. Now consider the opposite situation. Price is attempting to move higher, but RSI struggles to reach previous highs. Momentum becomes less responsive. Buying pressure appears weaker than before. Even if price continues rising, the trend is no longer receiving the same level of confirmation. The difference may seem subtle, but it can have significant implications. Strong trends tend to attract attention. As prices rise, more traders notice the move. New participants enter. Momentum builds. This creates a cycle where strength often feeds additional strength. RSI helps you monitor that process. Instead of asking whether the market has become overbought, ask whether momentum continues supporting the trend. That question leads to a very different perspective. Professional traders understand that trends are driven by participation. Buyers must continue showing up. Sellers must remain unable to overwhelm demand. RSI provides clues about whether those conditions still exist. One practical observation involves RSI ranges. In healthy uptrends, RSI often finds support at higher levels during pullbacks. Instead of dropping into deeply oversold territory, it stabilizes and turns higher relatively quickly. Why does that happen? Because buyers are stepping in before significant weakness develops. The trend remains intact because demand remains active. The same principle applies in reverse during strong downtrends. RSI may struggle to reach overbought levels because sellers continue dominating rallies. Again, the indicator is not predicting. It is confirming. It is revealing whether the underlying pressure aligns with the direction of the trend. And when RSI and price are telling the same story, traders gain something valuable. Not certainty. One of the biggest challenges in trading is recognizing change before it becomes obvious. Most traders notice a trend reversal only after a significant move has already occurred. By then, the opportunity is smaller, the risk is often larger, and the market has already revealed what happened. The question is this: can you spot signs of weakening strength before price fully reacts? This is where divergence becomes valuable. Many traders hear the word divergence and immediately think of a trading signal. They see it as a reason to enter a position, but divergence is more useful when viewed as information rather than instruction. It is a warning, not a command. Think about how trends normally behave. In a healthy uptrend, price makes higher highs and momentum generally supports those highs. Buyers remain committed. Demand continues pushing the market upward. But sometimes something changes beneath the surface. Price reaches a new high, yet RSI fails to do the same. At first glance, the trend still looks strong. Price is advancing. New highs are appearing. Most traders see nothing unusual. RSI sees something different. Momentum is no longer expanding with the same force. That difference between price and momentum is called bearish divergence. The market is still moving higher, but the energy behind the move is beginning to weaken. Why does that matter? Because trends require participation. They require buyers who are willing to keep increasing pressure. When momentum begins slowing, it suggests that demand is not growing as aggressively as before. The trend may continue for a while, sometimes much longer than expected, but the internal condition of the market is changing. And internal changes often appear before visible changes. The same principle applies in reverse. Imagine a market making fresh lows. Fear is spreading. Sellers remain dominant. Everything appears weak. Then RSI starts making higher lows while price continues making lower lows. What is happening? Selling pressure is no longer accelerating. Price is still declining, but momentum is beginning to improve. This is known as bullish divergence. Again, it does not guarantee an immediate reversal. It simply suggests that the forces driving the trend are behaving differently than before. And that difference deserves attention. Have you ever noticed how many traders enter the moment they spot divergence? That's where mistakes often occur. They assume the warning itself is the event. But divergence is not the reversal. It is the possibility of a reversal. There is a significant difference. Momentum can weaken for an extended period before price finally changes direction. Markets often continue moving even after the first signs of deterioration appear. This is why experienced traders combine divergence with price behavior. They watch for confirmation. Is the market beginning to break key levels? Are buyers gaining control? Are sellers losing their grip? Is price validating what momentum has already suggested? These questions matter because divergence is about context. The stronger the trend, the more important patience becomes. A powerful trend can absorb multiple divergent signals before eventually turning. Traders who act too quickly often discover that being early feels very similar to being wrong. The real value of divergence lies in awareness. It alerts you to changing conditions. It encourages you to pay closer attention. It shifts your focus from what the market is doing to how the market is doing it. Many traders lose money for a surprisingly simple reason. They spend most of their time fighting momentum. The market moves higher, and they look for reasons to sell. The market moves lower, and they search for reasons to buy. Every strong move is viewed as an opportunity to predict a reversal. At first, this approach feels intelligent. After all, buying low and selling high sounds logical. Catching the exact turning point sounds impressive. Being the first person to recognize a reversal feels rewarding. But the market doesn't reward opinions. It rewards alignment with reality, and reality is often defined by momentum. Have you ever noticed how difficult it is to stop a strong trend? A stock climbs day after day. RSI remains elevated. Every small pullback attracts new buyers. Yet traders continue trying to short it because they believe it has moved too far. What usually happens? The trend continues. Not because the market is irrational, but because demand remains stronger than supply. The trader is fighting a force that has not yet weakened. The same mistake occurs during downtrends. Markets decline steadily. Fear increases. Selling pressure remains aggressive. Yet traders constantly attempt to buy because prices appear cheap. The problem is that cheap can become cheaper. A market does not reverse simply because it has fallen a long distance. It reverses when selling pressure begins to fade and buying pressure starts taking control. Until that shift occurs, momentum remains the dominant force. This is where RSI can provide an important lesson. Many traders look at overbought and oversold levels as opportunities to trade against the current move. They assume extreme readings mean momentum is about to fail, but extreme RSI readings often reflect exceptional strength or weakness. They reveal what is happening, not necessarily what will happen next. When traders misunderstand this, they end up fighting the very information the indicator is providing. And fighting momentum carries a cost. The first cost is financial. Entering against a strong trend often means repeated stop losses. The market continues moving in one direction while the trader keeps betting on the opposite outcome. The second cost is psychological. Every failed attempt creates frustration. Confidence begins to weaken. Decision-making becomes emotional. Traders start forcing trades because they feel the market should reverse. That word should causes enormous damage in trading. Markets do not move according to what should happen. They move according to the balance between buyers and sellers. A strong trend exists because one side currently has control. Ignoring that fact rarely produces good results. Professional traders understand something important. Momentum deserves respect. Not because it is always right, but because it represents current market behavior, and current behavior is often more important than personal opinion. This doesn't mean trends last forever. Every trend eventually weakens. Every strong move eventually loses momentum. But there is a difference between anticipating weakness and waiting for evidence of weakness. One approach is based on prediction. The other is based on observation. The market consistently rewards the second approach more than the first. Instead of asking, how far can this move really go? Ask a different question. What evidence suggests momentum is actually changing? That shift in thinking can transform the way you trade. Because when you stop fighting momentum, you stop wasting energy arguing with the market. You begin focusing on what buyers and sellers are actually doing rather than what you think they should be doing. One of the most common mistakes traders make is assuming every pullback is the beginning of a reversal. The market dips for a few days and fear immediately appears. Traders who were confident during the rally suddenly become uncertain. They start questioning the trend. They wonder if the move is over. But not every pullback signals weakness. Some pullbacks are actually signs of strength. The challenge is learning the difference. This is where RSI can become extremely useful. Most traders focus on RSI when it reaches extreme levels. They watch for overbought readings and oversold readings.